So let's look at cost of capital. Cost of capital, it is the price that a company pays to obtain finances. So when a company wants to obtain finances, a company will pay implicit costs. These costs include what? Underwriting, commissions, brokerage. So underwriting is some insurance costs, okay, when you are obtaining finances. We have commissions, maybe there are people who will be paid commissions, brokerage cost. We have cost of printing the prospectus if you are issuing new shares. You have legal fees, audit costs, cost of printing share certificate, advertising cost, and so on. Then for debt, if a company wants to obtain a debt, then it undergoes costs like the legal fees, the valuation of security fee, bankers' commission, and so many others. So, if the company is obtaining shares, then it has to sell those shares at a price above the normal price, so that it covers the costs. Okay? Then, if a company is obtaining a debt, so if a company is looking for debt finance, then you look at the par value of the debt. Ukienda kuchukua loan sana, if you are going to obtain 10,000 na umeamua utalipa interest at ama some cost, kuna zile zinaitwa, there's some costs that are associated with obtaining a loan, kama excess duty and some kind of a tax unalipa before. So ukichukua 10,000 unaona imedebitiwa kwa account yako ikiwa 9,600. Okay, this is the cost. So when the company is obtaining the debt, it looks into the par value of debt. If it wants to obtain that is 10,000, the month after the debt, it engage you at 10. Then we have things we call flotational costs. When you're floating new shares, we have those costs. Flotation costs. So that one can be deducted from the market price per share. So if they are given for the total finance paid, then they are deducted from the total amount paid. So, well, now we need to look at the firm's capital structures and the factors influencing the capital structure. The capital structure is how a firm finances and how it finances operation and growth by using different sources of funds. So a firm may have different sources of funds, okay, for capital structure, and then it utilizes it from development, that is the growth, and daily operations. So debts, they come in the firm in form of what? Bonds or long-term loans. So you have debts. This is either kama bonds or long-term loan. What are bonds? Then kuna ingine inaitwa equity. Equity. What is equity? Equity is a common stock. Common stock. So, equity has been raised by who? The shareholders. Kuna retained earnings. These are the retained profits. Okay. So this is the capital structure of a company. Then something we need to look at, the things that influence the company's capital structure. Number one, things that influence this capital structure. Number one, we have business risk. This is number one. So as we have seen, our structure is made up of those three things. one of the things that influences it is the business risk. So business risk is the basic risk of companies' operations, and the greater the risk, the lower the optional debt ratio. So you will find that if there is any of the items here that has high risk, tunaiweka kando, there is a lower optional debt ratio. That is, you will find that most companies, they don't go for this if they want to raise a good amount of finance. On that will increase capital by 100 million. You end up with around, they decide to do theirs. Then we have tax exposure. So there is the firm's ability to raise capital in bad times. Tax exposure, first of all. So debt payments are tax deductible. If a company's tax rate is high, using debt means as a means of financing the project is attractive because the tax deductibility of the debt, that is it, tax exposure. So when you are calculating the tax for a limited company, how did you see about the debt? Not the debt itself, but about the interest on loan. Is it allowable? Is it not allowable? It's allowable. So you'll find that the company can opt to go to debt capital because it will be allowable expense. Haita taxiwa. Right together. You have financial stability, financial flexibility. When you talk about financial flexibility, it is the firm's ability to raise capital in bad times. So it should come as no surprise that companies typically have no problem raising capital when sales are growing and earnings are strong. However, given a company's strong cash flow in the good times, raising capital is not as hard. So there is a company that can have that ability to raise capital even in bad times. So the financial flexibility of the company, it will influence the capital structure. You have some companies that cannot be able maybe to raise debt at certain times. What will happen? Capital structure can reduce. Okay? The management style. So management style range from aggressive to conservative. So umefanya PPM. So the more conservative a management approach is, then the less inclined as it to use debt to increase profit. So if the management style for conservative, unamuda wapende kuchukua mali. Okay? That's another factor. It affects ama it influencing capital structure. Kwa sababu na management style inataka watumie hii ama hii ama. Yeah? You get the point. The growth rate. Growth rates. Firms that are in growth stage of their cycle, they finance that growth through debt. So the conflict arises with this method is that the revenues of growth firms are typically unstable and unproven. So you find that the firms that are at a growth phase, zinaanza grow. Okay? You find them they make using what? Debt. Okay? So their capital structure will be influenced by the growth rate. Some of them that has been there for long, then they can use other methods. So that's another factor that affects the capital structure. We have market conditions. It's another factor. How? Suppose a firm needs to borrow funds for a new plant. If the market is struggling, The investors are limiting the company access to capital because market concern, the interest rate borrowing, and so on. Market condition. Okay? Sasa, there is a firm here that is doing a particular business. Okay? Lakini hiyo business haifanyi vizuri, iko down. Okay? Ukiwa bank utawaambia loan. Ukiwa shareholder utanunua shares huko. And the company inaonekana the condition of the market is not good. Yeah, that's another factor. So these are factors that influence what? Capital structure. Already now you know what is the capital structure, isn't it? Now these are factors. Then, factors influencing cost of capital. Remember, we said that cost of capital, it is the price the company pays to obtain and retain finances. Now, what are the factors that influence the cost of capital? One is terms of reference. Hata ukisikia mshwari unalipa na 5% and another form of loan unalipa na 10%, which one will you go for? The terms. So if short term, the cost is usually low, and vice versa. You also find that in terms of reference, short term loans, they are very expensive. Example of short term loan, bank overdrafts. Okay? So when you are in a company, January imeisha, and you don't have enough money in your account to pay the salaries and rent and everything, what will you do? Una apply to kwa bank, unawaambia pay advance. Okay? You can give me an overdraft, advance in your employees. Akupea overdraft, then you will pay in the next 2 months. Okay? That money can go na interest moja kali sana. Okay? It's very expensive for short term. Okay? Na sasa kama huna pesa na lazima ulipe salaries na rent, utafanya, you go for it. Then, economic conditions. Economic conditions prevail. So if a company is operating under inflationary conditions, then that company will pay high costs. So effect of finance will be passed onto the company. Yeah, the economic condition. Then, another factor influencing cost of capital. So, at that time, in our desperate borrowing, you pay very high interests. Okay? Yeah, economic conditions prevail. So a company will pay high costs when it has such inflationary costs. You always funga kampuni to invoice so you're prospecting. Then the risk exposed to venture. So the risk exposed to the venture. Sasa, if a company is operating under high-risk conditions, such company will pay high costs to induce lenders. So yeah, if company inafanya business which is high risk, wakienda kukopa loan, wanalipisha interest kubwa. Okay, that's common. So high risk venture. So the lenders, they pay high costs to induce the lenders to avail finances to it because the element of risk will be added to the cost of finance. The size of the business. So the size of the business. A small company will find it difficult to raise finance. As such, they will pay heavy form of cost of finance to obtain debt from lenders. The size of the company. A small company, a small business will not be able to raise equity. Okay? So when they need finances, itabidi waende kwa debts, and then they will be paying more. You know now tunaenda kwa Shairo. Shairo, thou urudisha na 200. And it is within 1 month. It is 1 month or 1 week. It depends on the amount. 1,000 to 5,000 is 1 week. 1 month to 1 week. 5,000 to 1 month is 1 month. 1 month to 1 week is 2 months. 2 months to 1 month is 3 months. 3 months to 6 months is 1 year. 1 year to 6 months is 1 year. 1 year to 1 month is 2 years. 2 years to 6 months is 1 year. 1 year to 1 month is 3 years. 3 years to 6 months is 1 year. 1 year to 1 month is 4 years. 4 years to 6 months is 1 year. 4 years to 1 month is 5 years. 5 years to 6 months is 1 year. 5 years to 6 months is 1 year. 5 years to 1 month is 6 years. 6 years to 1 month is 1 year. 1 year to 1 month is 1 year. 1 year to 1 month is 1 year. 1 year to 1 month is 1 year 5,000 to 10 inakuwa 1 month. So 10,000 unarudisha na 2,000. So really, size of the business inafanya unaenda unakopa. Because when the end month has come, unakuwa na mfanyikazi na hujamlipa na nyumba ni ya wenyewe, ni ya kurent. What will happen? What will you do? Na hakuna pesa kwa account inatosha. Unahitaji kama 40,000, you have 20 ama 25 in account. What did you do? Size of the business inafanya you get a costly finance. The nature of security. The kind of the security you are using. So if the security given depreciate fast, then this will compound the increased cost. So if umepeana security, you are depreciating assets, then you have to pay more. So yeah, you have to pay a lot of cost. In security, kama ya shamba, utakuta interest yako itakuwa kubwa. Explicit costs obtain that one. Company's growth stage. A company, young companies, they usually pay less dividends. So young companies, they pay less dividends, so the cost of capital or the cost of equity there in a one, it's low. It will be relatively cheaper at earlier stages of the company's development. Then, relevance of cost of capital. Here we talk about cost of capital is considered as a standard comparison for making different business decisions. So number one is making investment decision. Why do we have to learn cost of capital? That is what we mean by relevance. Okay? So cost of capital is used as a discount factor in determining the net present value. Similarly, the actual rate of return of a project is compared with the cost of capital of the firm. Thus, the cost of capital has a significant role in making the investment decision. So whenever we are making any investment decision, we base it on the cost of capital. Because we want to buy a new machine. How will we finance it? Will it finance it by addition of shares? Or will it by getting a loan? Or will it by equity, retained earning? That is there in making investment decision. Also, designing a capital structure. Yeah, when you are designing a capital structure, the proportion of debt and equity, that is what we call the capital structure. Equity and debts. Okay? Finance line. That is the capital structure. Okay? So when we are designing that, we use what? The cost of capital. Ndio tunatumia zenye those that we can afford. Tukiona loans zinatusumbua sana, tunaenda hata tukizitoa capital structure yetu, tunalipa loan ya wenyewe. Ziko na cost. Cost ni ile ya maintain the interest. Okay? Dividends, equity nayo tunaimaintain na nini? Na dividends. Sindio? Na unajua dividends, if there is no enough profit, you can decide not to pay dividends. Sindio? Tukisema ordinary shareholders, they are the mercy of the directors. Directors ni wanajikerea dividend. Haya, kuna preference shares. They get a fixed rate of what? Of dividends. Sindio? And then tukiona inatusumbua sana juu ni fixed na profit yetu imeendelea kukua down, and we are paying a fixed percentage, we can decide to join a capital structure, isn't it? Warudishie pesa tubaki na ordinary shares wenye hatuwalipangi dividends tukijisikia. Are you getting my point? So when you're designing the capital structure, we use the cost of capital. Then evaluating the performance. When you want to evaluate the performance, we also use the capital structure. So the cost of capital, it's a benchmark for evaluating the performance of different departments. The department is considered the best, it can provide the highest positive net present value. So unachukua department, unatafuta net present value. Unaona kama hiyo department inafanya vizuri. Okay? And then we use the cost of capital when we're doing all those. So the activities of different departments, they are expanded or dropped out of the basis of their performance. So when you want to add new activity in a department, or we want to drop it, we can only do this cost of capital and we see how much that department will carry. Inatukulia capital inatoshana aje. Tunakopa, tunawekea domain, wanakataa kufunza online. So what do you do with that department? When you are evaluating performance, unatumia any net present value, lazima utatumia cost of capital. Okay? Also formulating dividend policy. So, wakati unataka kutoa dividend policy, lazima utapiga hesabu kulingana na capital structure that you have. So, a firm can retain all the profits in the business if it has opportunity of investing in such projects which can provide higher rate of return. Yeah. So, dividend policy ni ile policy ya board of directors. Wanasema hii mwaka tutalipa 1 shilling per share, hii mwaka tutalipa 10 shillings per share. Okay, how can you formulate that? You have to use the cost of capital. Yeah, sometimes they decide not to give the shareholders the dividends, lakini wa invest hiyo pesa. Instead ya kupea shareholders, wana invest in the company, wananunua a new machine, sindio? Business may improve. So that next year, instead ya kuwalipa 10 shillings, itakuwa ni 15. The business may increase to ile mtambo mpya mlitununulia last year. So when you're formulating this policy, then unatumia cost of capital. Let's look at the components. The individual cost of each source of finance is called component. So these are the individual source of financing. Equity is a component, okay? Debt is a component, and retained earnings is a component, okay? So the component of cost of capital is also known as the specific cost of capital, which includes individual cost of debt, preference shares, ordinary shares, and retained earnings. Those are the components. So we have to look at the costs of debts, preference shares, ordinary shares, and retained earnings. We go by each. The cost of debt. They include what? Costs of debt. We have the cost of perpetual irredeemable debts. So debentures, it's a debt. Just like the way we issue shares, the company can issue debentures. Okay? Debentures sio kitu kitakuja nikukuteni kudeni. Okay? It's a right. Unapea kampuni pesa yako. Na umeagree watakuwa wanakupea nini? 9% interest every year. See 9, any percentage. Okay? Sawa, kutoka hapo unakuwa debenture holder. Okay? Na ile kampuni inakuwa ikisema wako na debentures, wameuza debentures ikawaletea hii pesa. Suppose wewe umenunua debentures za 100,000. Mimi nimenunua za 200,000, mwingine amenunua za 500. Hizi pesa zote ziko kwa kampuni invest. Sasa alafu we have some debentures which are irredeemable. So that means cost yake itakuwa gani? Hii forever. Si ndio? Debenture holder akikufa, tuna transfer the right to the next of kin. So, that is one of the costs of debts. So, another cost of debt is cost of non-perpetual redeemable debts. So you have non-perpetual redeemable, non-perpetual or redeemable. That means we are going to be incurring a cost, a interest, sindio? Alafu after tuseme ni za 10 years ndio zitakuwa redeemed. After 10 years itabidi tufanye nini? Turudishe pesa za wenyewe, isn't it? Those are the costs of debt. That's another cost of debt. Then kuna hii costs of debt issued on redeemable condition. Kuna condition mnawekea hapo wale wanataka redeemable, sindio? Yeah. So utakuta utalipa interest and then ukiredeem you will also add another cost or something like that. So if there is any other cost like that, we call it, we classify it together with what? Other costs. So this is called cost of debt. Then we go to what? Cost of preference shares. Cost of preference shares include what? The cost of perpetual, preference shares. Preference shares also, we have redeemable and irredeemable. Okay? Yeah. So we have cost of perpetual. Perpetual means irredeemable. And cost of redeemable. Preference shares. So, then we have the cost of ordinary or equity shares. We can also call them common stock. And then we're also going to look at what? The cost of retained earnings. So, that is all. You need to know about the cost of capital. And methods of, or methods or models of computing cost of capital. We have weighted average cost of capital. We call it WACC. I hope you have seen this in past papers. It's called the overall or composite